Okay.
Used to have a big team, and thinking that we have to do it all, right? And end up being a big expense. And somehow, the bigger the company is, the more red tape somehow it becomes, and you become slower, actually.
Welcome back to the Massive Passive Cash Flow Podcast. I'm Gary Wilson, your host. I'm so glad to have you back listening to the show or watching if you're watching on YouTube or Facebook or LinkedIn. Obviously, it's the 30 different channels. We have a great guest today, Jean Paul Szita, and we're going to talk about, of course, real estate investing. And Jean Paul has some unique approaches to what he does. So I'm going to just let you listen to him instead of me. So, first off, Jean Paul, thank you very much for joining us. I really appreciate your time. I've read about you, and I've been really looking forward to this podcast for a long time. So thank you for joining us.
Thank you, Gary. It's a mutual pleasure, and I have heard great things about you, and it's a pleasure
Mhm.
to be here.
Thank you very much. Well, I tell you what, I'll always like to start with a little bit of background because most of us we don't start out in life saying, "Hey, I'm going to be involved in real estate." We want to do something else, like be an airline pilot or something. But what was take us back to the beginning. Like, what got you involved in this? What were you doing at the time, and how did this develop? Mm.
Yeah, it's. I need to take you a little further back into the story, because I end up in real estate by accident, and by
Mhm.
saying that is that my family were immigrants from Hungary, and after the Second
Mhm.
World War, they decided to migrate to a stable country, so they migrated to Chile in South America.
Okay.
And there, my grandfather, his career was in clothing, and started a company, a manufacturer company, producing suits, where he delivers politicians and so on. By the time me and my brothers were born, right, everything was already done. And
Mhm.
my father died when I was 11 years old, right? And I always wanted to work in the firm.
Mhm.
And over the years happened, I started working in the firm by 16. And by 18, young and naive, I got seduced by, you could say, a lot of influences around. And me and my brother ended up selling the company. We merged to a bigger
Mhm.
firm. And then at the time, our banker decided to say, "Hey, what are you guys doing?" And we just had no idea. I actually wanted to open a restaurant. And we said, "You guys should go to Los Angeles." I said, "Why Los Angeles?" "Well, you have the girls, the movies, the cars." And I was so young and naive, and I got impressed that I said, "Well, why not?" Right? And so I did a couple of trips to Los Angeles. I ended up being there. And at the time, I wanted to continue with the family tradition, what was the clothing business. So
Mhm.
we decided to have a chain of stores, right? And we tried to associate with the right people, but we ended up with a venture capital that convinced us that that would be the right way to go with them to make it bigger, and everything will work better. And they say, "You know what? You start investing your money, and you start doing everything, and we will come back when funding comes. We will reimburse you." And we're like, "No
Mhm.
problem." Long story short, we were a scam, and millions of dollars. The
Mm.
funding never came. End up losing everything, the
Mhm.
house, cars, everything. It was so bad that at the time I even ended up being evicted from where I was renting a place.
Oh, wow.
It was really that bad.
Yeah.
So I decided to start again in the clothing business again, in the East Coast.
Mhm.
And the only thing that I had was my reputation and what I had in my head at the time. And so we ended up creating a wholesale company, and learning with a lot of lessons at the time. We thought that, well, this time we really nailed it, right? And the company grew too fast, opening offices in Mexico and Chile, and we have
Mhm.
another one in Milan. And unfortunately, the offices in Milan, I'm sorry, in Mexico and Chile decided to collide somehow, and they stole our inventory and accounts receivable and put the company out of business. A big lessons learned on that time. And so I had to restart again the clothing business because that's what I knew. And we are already at the end of the 1990s.
Mm-hmm.
And we ended up buying a company in San Antonio, Texas, where we have vertical integration, right? So we can produce from the manufacturer. We have to control the mill, the manufacture process. We end up to the store, and we can mark up by 8 times. And at the time, it seemed like a great business until the economy changed, and the formal wear wasn't the most appealing, and the revenue started crashing, and we couldn't sustain it anymore. And unfortunately, that company had to close. And it was another big lesson. And that was early 2000. And it's like, okay, so what's next, right? And accidentally, I ended up knowing one of my mentors who was in real estate. And somehow, because he started in a humble way, by the time I met him here, where he had more than 45 hotels, although he started for nothing. And he felt compelled, and I don't know if maybe he wanted to help, right? And start teaching us some of these tricks and how to put it together, right?
Okay.
And at the time, I think I remember saying, why don't you do it? Why do we have to have investors? Why do we have to have partners? He said, if you cannot sell it to an investor, it's not a good deal. Main concept. And there is nobody that can do this alone. The industry is so big that it's impossible to do it alone. This business, especially if you want to buy good properties, is the accumulation of everybody's wealth to do it, because there's no way to do it by yourself, unless you want to buy house by house, but that's really, you wouldn't consider real estate. I'm going to get into that soon. So the first deal, really, with the help of God and him, and I was able to close, we closed the first deal, and $75 million. That really put me in business, right? But in the beginning, it was as a service for other people. And we did a couple of deals like that until when the financial crisis came, 2008, 2009. And then when we realized that, hey, there's a ton of deals that can be done, but everybody was so afraid of it. And only a few investors were able to jump with us in those deals, and they did spectacular. Because as I said, when things are down, it can only go up, right? And not everybody understood that, and everybody was very afraid. So at the time, we decided to create investment funds, investment vehicles, to have control, you can say control of the checkbook, to be able to deploy in those with that discretion. So during the next few years, we built a portfolio of about $1.2 billion in properties, and overall did business within different things, about over 2.5 billion. And right before COVID hit, some people say we were lucky or not, but that company got unwinded and decided to spin the company into a different firm, learning the lessons that were learned from before. Used to have a big team, thinking that we have to do it all, right? And end up being a big expense. And somehow the bigger the company is, the more red tape somehow it becomes, and you become slower, actually. Yes. And so a new team, smaller, and doing more things on, you can say, laser focus, and in a way of outsourcing most of the of the work. What I'm saying, what Canada said is because when you are dealing with investors, many investors focus on the fees, right? And you will say, hey, I'm doing it all. You're paying me. But they see it as you are the whole thing and you're collecting all these fees. And we discovered that most of the investors, they prefer to, even if they pay more, to be outsourced, to be third parties. And over time, I realized, well, you know what? It's better for me. Because I always said, you cannot fire yourself. You can always fire the guy underneath you. He's not doing the good job. So one time I visited a colleague of mine, and he was doing probably 10 times more business that I was doing. And I go to his floor and I realize, where's everybody? Well, I mean, is everybody in another floor? And he said, no, here's everybody. I said, and there were like 10 people. I was like, how could that be possible? And he said, because you don't know how to charge, JP. I was like, what are you talking about? Yes, we do everything here, and the rest, every project is outsourced, and our fee comes from us. That's why we're able to charge low fees, but that's net for us, and the rest, it goes everything outsourced. And really that opened my mind that really of a new way to do things, more focus on the business and not necessarily in the business so much. So over time, and I'm learning a lot of experience. I've been 25 years in business. I realized at some point that things need to change a little bit in the sense of common sense needs to come back to reality, right? And I realized that we don't want to be competing with who offers this, who offers that, because at the end, based on what I have learned, and especially in real estate, properties have a heartbeat, right? Excel, I always say, Excel, you can put whatever you want, and you can have the most outrageous projection and try to back it up any way you want. But at the end, nobody has a magic thing that nobody else has, right? Anybody that knows the business knows that, hey, they behave this way. And if I do this, this will happen. What will change if you put too much debt and you are too aggressive, right? And when a property gets in trouble is when you put too much debt on it and your projections were unrealistic and you were undercapitalized. And that's when trouble begins. So I said to myself, you know what? I want to sleep in peace here. And by sleeping in peace, meaning that I need to have a shift in mentality to, in a way, sit next to the client. And by sitting next to the client means that most of during the career, we are like, hey, this is our client, I'm trying to sell him something. In this case, actually, no. I'm on the same side of you. I want the best for you, because if you do well, I'm going to do well, and I'm going to sleep in peace. And with that concept, develop this, basically, you can call it a very core strategic strategy that is really common sense, and the sense of goes like, listen, we're only going to focus, and this is for all the listeners, this is what you got to do, is focus on the main markets. Markets are growing. Whatever works, historically works, probably will continue to be working. Focus in newer properties, ideally Class A properties that you don't have to touch, because you can do all the due diligence you want, but nobody will let you open one of the walls. Because if you're going to do a major renovation, the moment you open the walls, trust me, things can change radically, dramatically. And renovations from something so simple can become a nightmare, and suddenly you're underwater. So by focusing in newer properties that are well located, half of the nightmare is there, especially if it's a Class A property that is already stabilized and it has a good management. You don't have to touch it. one of the lessons that I learned one time was like, we used to go in, change management with the people that we trust, and let it run and do our business plan. And guess what? In one of the properties, we went in and it was doing fantastic. We changed management, and new management, although they had expertise in the local market and brand name, the best of the people, they couldn't perform like the previous management. And we couldn't figure it out. But really, the previous management was able to really nail the formula to a point like for that specific property, it was performing fantastic. And it was a big lesson because it took a long time to get it to that point again. And that after that point, we realized that if it's doing great, don't break it. Let it run, because if it's already doing fantastic, don't let it run, because that's where the heartbeat comes around.
Okay.
Some people, there are many deals in the market where they tell you, hey, I'm going to do this, you're going to make 20, 30% IRR, etc. And sometimes you look at it and you're like, how are you going to do that? Right? And they think they're going to take this old property and they're going to make all these changes and they're going to compete with the new one. But guess what? The old property, you won't be able to compete with the new one in price, because everybody will always choose the newer and improved one. Even if you put millions and millions of dollars here, you're going to end up getting close, but you're never going to outperform the new one. And guess what? The old one is going to give you a ton of headaches, and it will always cost more than you thought it would be, and it will take longer. And in today's market, it's not even worth the nightmare of doing all that exercise. So yeah, those were big lessons that I learned, and so now I focus on a more conservative approach, back to common sense, and basically having the 2 feet on the ground.
Did you know that you can participate in class every Monday? We call it Monday Night Live, 7 p.m. Eastern, with me and dozens of other investor agents from around the country, in fact, the world. Every Monday, totally free. No selling, no recruiting, just straight up education on anything and everything in real estate. And we have a lot of good guests coming on once or twice a month, bringing in expertise on subjects like how to buy a house with crypto. Okay. How about them apples? What about AI? How's AI affecting our business? How about the metaverse, blockchain processing? We're already using it in title work. So come on to Monday Night Live. Be ready to take notes and ask questions, because it's live and engaging, and you get to participate by asking questions and meeting others. So we'll see you there. Go to realestatewithgarywilson.com, click on the resource tab, drop down, and you'll see Monday Night Live. And in there, you can see one of the most recent classes. But more importantly, you can register for class, as many as you want, going up to like the end of the year, I believe. So in any case, do that. We'll see you on Monday Night Live. Look forward to meeting you in person. Take care. Yeah. Well, so obviously there's a lot there. I really appreciate that. And I like the fact that you focus on the better properties. And I agree 100%. I've lived a life of, when I first started, I would buy the less expensive ones because they were more affordable and the cash flow looked better. But what I learned quickly was that cap rate didn't just reflect return, it also reflected risk. So the higher the cap rate, higher return, but also higher risk, which means, usually the buildings are older. It was the tenant relationships were not as easy as if you had a good grade A property. The values go up more on the better properties, the appreciation. So it's easier to preserve the capital. So how do you approach that? How do you approach capital preservation when it comes to what you're doing, especially if there's others involved and everybody has their own personalities,
Exactly.
Yeah.
And and you mentioned something important about cap rates and so on.
Mhm.
There is an element that cannot be measured, which is, let me give you an example. There are 2 restaurants, one next to each other. both in a great location. We all have seen this. You go in one, you cannot get a table. It's impossible. And the other one is empty. And they both probably cost the same. How do you measure that? Right?
Yeah.
You, in terms of investment, anybody would see it. It's like, yeah, it doesn't make sense. Well, I call it execution. And I'm a firm believer that the idea is just the beginning. It probably is 10%. The execution and the experience, that's what makes a difference, right?
Yeah.
And going back to your question about capital preservation, I thought, talk to our team and said, what is the best way to preserve capital? And it's like, you gotta start backwards. When do things go wrong? When you have high debt, low revenue, that will catch you. And no matter what property, you will get, if you are undercapitalized, that's when you're in trouble. So we decided to, you know what? We cannot be competing with all these people that with these crazy projections, being irresponsible. And I call it crazy because yes, if all the stars are aligned and and all the saints came together, yes, it will happen, right? But in reality, things happen all the time. And as you may know, Gary, not a single deal happens according to the business plan. Something happens all the time. Every deal has a hiccup. Every deal has a hiccup somehow. So we decided, okay, let's, for example, in all these deals, especially coming from the institutional side, it's more like when you go to the buyer's interview, right? The first question they're going to ask you, where's your equity coming from? And most of the syndicators are going to say, well, I have this money for the deposit, I'm raising the difference, and then the clock starts, right? And everybody start running around. Hopefully you can put it under contract at a reasonable price, because if they sell it to you, if you don't have the money, it's because they don't have anybody else that has the money, pretty much, right? That's why they sell it to you. So then the typical syndication starts with that raising, and they start spending money, putting under contract, and so on. And because they have a timeline, usually as the timeline gets squeezed, they try to improve the Excel to make it more attractive to get people in, right? And most of the time, they are not able to get the full capitalization that it needs to close because it's not enough time. And at the end, you end up with a deal that you purchased it not at the best price, right? You close because you had to close, because otherwise you're going to lose all this money. So you had to close, probably undercapitalized, and that means that you had to put more debt. So I said, this is craziness. So it has to be, we need to reverse engineer this and then others. So we decided to, for example, in the case of our firm, and of course, any investor that has the capability can do the same thing, is that we said, listen, we are going to create our investment vehicles that are going to invest in these very strict criteria, right? And we did one, and in our example, we defined 3 different criteria, but for the effect of the exercise, they all work in a very similar way. And the idea is that our clients invest in the acquisition criteria that is very strict. We have a legal framework that we can only be inside that criteria to pull the trigger, and that which allow us is to arrive in a position of strength. So when we're looking at a deal, we are not committed to a specific deal. We are committed to make the numbers work. And in that sense, it gives us the strength to negotiate with cash. Where's the money? It's right here. We can close in 30, 45 days. In some cases, depending on the structure that we have, we may close in 10 days, And that position, and I have seen it, they have done it to me in the past, when you have a deal at a great price, somebody comes underneath you and sweep it for less price, because it's a certainty to close. So that's number one. The first profit needs to be made at the acquisition time. And then, of course, let's put low debt, ideally 60%, 65 tops, no more than that, but ideally like 60%. And obviously, by doing less debt, it's less mortgage payments you have to make, and having a well capitalized. Things happen all the time. You saw what happened in COVID or any other things. Things are unpredictable. We live in an unpredictable world, and you cannot rely on Excel, especially if you are dealing with other people's money, right? And that's where you put yourself in this mentality. It's like, I really need to protect the investment of the client that he already made his money, and he's looking for a place to put it with certainty. And all this strategy, you may say, why doesn't everybody do it this way? Because it has a cost. The cost is like, you're not going to make these crazy returns. You're going to make realistic returns, which in the long term, they're going to pay you better. Because in the 5 years, let's say, the property is going to own a loss less, and you're going to be making more. And you know how then the writing is. You cannot be too aggressive. So you can only say rents are increased 3% a year, and expenses or so on. And that's what we had to do. But in reality, that the rent goes way beyond 3% a year in the good markets. And especially with inflation, it's an excellent hedge against inflation. Because one thing is for certain, if you leave the money in the bank, you will lose money. Because if you put, for example, 100,000 today, a year from now, you maybe will be able to buy 90,000 of today's money. So that's an issue.
Well, I tell you what, I really, that was actually going to be my next question is, and you kind of went over it, was your strategic approach, the strategies, and it's so important to be flexible and adapt to what's changing in the market. So when it comes to your investment decisions, I mean, how again, we all have our own personalities, but how do you see your personal values and principles influencing your leadership style and your investment decisions?
Yeah. We as head of the company, and really, I decided to be guided by God. And some people said, we even put something in the website, and that's what the company means, BEO. Example, our company is called BEO. And BEO is blessing. BEO investments is blessing investments. And some people told me, why are you doing that? You're going to piss off some people. I said, that's fine. Because the people that get pissed off, I don't want them as a customer. I want the ones that have the same values and principles that we do. And guess what? I think most people will resonate with that. So yeah, it's doing the right thing and without stress. And that's why we developed this strategy. And in terms of looking at things in the market, by having a position of strength, we can, and through our network, we can find properties off market and play tough. Because when you have the cash is king. Everybody knows that. Everywhere you go, you have cash is king, and you can compete with the big guys. Now, our sweet spot is too big for the little guys. All the doctors, attorneys that they get together, but it's too small for the bigger guys. So we try to be in that spot where we really is our niche, where we can compete and play hardball.
Okay, awesome. Now, you mentioned earlier, your approach and your spiritual beliefs that influence you, and I agree 100%. I mean, if you live long enough, you realize you're going to have challenges, trials, as well as triumphs and successes. But you realize so many of the factors that were involved in anything that happened to you were beyond beyond any of your own thinking. It's not, it's, some people refer to as creator universe. I refer to it as God too, you know.
Right.
Um, and, and has that played a role in in relationship building? Like what would you say are the keys, or what is a key to building trust and long lasting relationships with your investors? I mean, what comes to mind when you think about that?
Yeah, I think people do business with people they know and they trust.
Hmm.
Deals are everywhere, everywhere.
Hmm.
Everybody's offering you a deal. Now
Hmm.
people call, a guy called me and said, I have this deal. Most people say goodbye. I don't know this guy. So I start from the principle of trust is something you need to earn. In
Hmm.
today's world, everybody many people believe that, hey, trust me. I don't trust you. Trust is something that everybody needs to earn, and for that you need to show it, and you need to build a relationship, and the relationship get built in the long run, because
Hmm.
it's like a little cat, a little dog. You can be very nice to the doggy, and you do something wrong. The dog is gonna fear you for a long time. It's gonna take you a long time to heal whatever wrong you did to that dog. And in many ways, in our animal part, we are built the same way. We do business with people we trust. It might not be the best deal or the best perceived deal, but
Yeah.
you're happy and you trust that person, and the relationship get built in the long run. Nobody can make a living out of one deal or two deals. We all need the collaboration of many deals, and in the long run, and to me in particular, I want to be good to you, because of course, I want to help you, but I want you indirectly. Yeah, I want you to bring me your brother, your uncle, and so on. And over the long run of the years, we become a big family. And I'm more focusing, less is more.
Yeah.
I'm not looking to have thousands of customers. Few, but good ones. Fewer
Hmm.
properties, but nice properties. You know,
Hmm.
at the end, I
Yeah.
wanna I wanna be in peace. I wanna be in peace with the Lord. And sometimes when you try to grab too much, things will start going
Hmm.
through your fingers. So I prefer to, hey, let's do
Exactly.
less but better.
I agree 100%. Well, how can people, I, I, I understand the website is beobest.com, beobest.com. Is that the best way for people to learn more about you and how to work with you? I mean, do you have any active projects now that you're working on, properties you're looking at for to present to investors?
Yeah, well, yes, the website is beobest.com. It's the best
Hmm.
way to go there and learn about what we do. And we have multiple initiatives. And what I said that is that if you we have three kind of different vehicles, right? Because over some time we realized that even people that think they know what they want, many times they don't. And it's an
Yeah.
example. It's like they say, "Oh, I only invest in this kind of property," and you talk to them, and then they tell you, "What else are you doing?" And you explain them, and then they say, "Oh, what about this one?" I said, "That's not what you do." "Oh, but I like it," and they can flip in 2 seconds. And over the time, and we developed these three different strategies, and we're happy to explain you. For example, in the first vehicle, we really had to be very creative, because we have this we call it the smaller clients. They have a couple of 100,000, maybe to 1 million or two, and they wanted to invest in real estate. And after COVID, the bigger clients, they say, you know what, I don't want to do syndications anymore. I want to do this whole thing. And then you are
Hmm.
left with, okay, what do I do with all these other clients? And I firmly believe what I call the dentist approach. One day I had years ago, I had an issue in one of my teeth. And I called my dentist, was on the weekend. And he said, come over, I will take care of you right away. I said, are you sure? It was like a Saturday or something like that. Yes. And after he was seeing me, and I said to him, how come you open for me? And he says, very simple. You would have found somebody else to take care of you, and most likely I would have lost you as a client. And that resonated to me years after years after years. So applying that concept, I'm like, if we cannot find a solution for what you can call smaller clients, what are we going to do? They're all going to leave, right?
Yeah.
So, okay, so we were like, okay, how can we create a vehicle that in this particular one is people that they want to invest in real estate, but they don't know much about it. They like what it is, but they don't like the complexity. And most importantly, they don't want to be in the typical 5-year holding period. And on top of that, you can put the cherry on top, but they want to make the equivalent of what they would make in commercial real estate. The impossibility. And we were like, wow. And that was a feedback from a lot of customers. And we're like, this is a really tough one, right? But after listening and looking in our marketplace, we decided, you know what? We're going to reverse engineer this. And we end up developing a vehicle that to develop luxury waterfront properties in Miami. You know, those mansions that you see on TV, 15 to $30 million that are sexy and so on. In the beginning, we tried to make them smaller, but the numbers didn't play out. It had to be bigger. It had to be bigger for the margins and for everybody to be enthusiastic and for the resale price to be better at the end. You know, so we develop a team and with really, really good professional people that between a brand name architect, with a special project manager company based here in Miami about engineers, that they have done the Porsche Towers and other major things, as well as homes for celebrities. We came in with this team and this structure that can give investors approximately 15 to 20% IRR or 40 to 60% return on their investment between 24 and 36 months. And that has resonated very well. And then we say, well, we need to have our typical bread and butter. Well, typical bread and butter is a multifamily, our fund 2 is a multifamily vehicle, Class A, stabilized, that from the moment we acquire it. It pays monthly distribution, and it should give you around 6 to 7% a year yield. And at the end of the 5-year period, you should get between 12 to 14% IRR, which is a standard for a core property like that. And then, but then you have the other kind of investors who say, listen, I don't want to do anything with development. I don't care about the monthly distribution. I want my money to grow faster, and I want to be more aggressive. Well, that's why we developed our Fund 3. Fund 3 has a broader language and a broader acquisition criteria. It can invest in any kind of real estate, any kind of real estate. And we have the ability to travel through different types and classes of assets. And also during the first 36 months, we have the capacity to reinvest the capital so we can create a compounded effect. So we might not have to buy something very spectacular, but we do smaller deals, but really it goes into opportunistic mode. When we see blood, on the market, we go there, we acquire, and very aggressively, we might flip it in a year or two and use a compounded profit to invest it in the next one and create a more aggressive IRR. Still, we are offering a 20% IRR plus, which is not crazy, but it's still under a conservative scenario, not too much debt, not going too crazy, but trying to be more aggressive in the types of asset and in the purchase price.
Okay, awesome. Well, I'll tell you what, this has
Also,
been
let me tell you,
Oh, sorry.
and the last thing I forgot,
Okay.
and also,
Mm.
since we deal with a lot of international customers,
Mhm.
and that's for the funds. But for groups that they want to do their own thing, they say, what,
Mhm.
we don't want to invest in the funds because we would like to be in control of our own investments. That's why we
Mhm.
have our joint venture initiatives where we can customize the special programs for what the client needs, and we can tailor it and adjust it based on that. So it's very flexible in that sense.
Yeah. Well, it sounds like there's some great opportunities for really, people with different personalities and investment styles. And so everybody listening, just remember it's beobest.com, BEO best, BEST.com. And I'm sure you'll find a way to contact through the website with John Paul, learn more about this, their investing style, the three different types of opportunities. Um, and I thank you, John Paul, for being here. And I thank you, listener, for listening. We really love your reviews. If you could leave a review for this, that would be great, because that's what makes the podcast world go around. And any case, in the meantime, take care of yourselves. God bless you and your loved ones. And we will see you on the next Massive Passive Cash Flow podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.